Thank you, everyone, for joining Sonar 201 training. My name's Donnie Gilbert. I've been in the freight business a little over 15 years and primarily grew up in the spot market. I've booked loads off the spot market for an asset based carrier and spent my last probably almost 10 years in a brokerage firm where I would book loads that normally picked up same day. And sometimes, if I was lucky, would pick up the next morning. What we're going to look at today is a lot of the indices that I would have loved to have had back in those days that would have helped me understand the volumes and capacity for pricing these loads. So I'm going to start out today with volumes. So let's go ahead and jump in here and get started. When you bring up Sonar, you'll probably have a blank page. Mine already has several pages that I've saved on it, but I want to start out by first going to our knowledge center. Up here in the top right, you'll see the circle with the question mark in it. You want to click the question mark and scroll down to the knowledge center. In the knowledge center here, you'll see right here in the middle, indices by category. Click on the indices by category. You'll see here a list of the indices that we use in Sonar, and there are a lot of indices. We'll primarily be looking at the supply and demand and the volumes indices today. But as you scroll down, you see that we have agriculture volumes and rates, air cargo, company financials, some demographics, data information, energy pricing, energy volumes, environmental, our freight futures, some another economic indicators, and we got maritime, and along with rail. Here's one of our categories today that we'll be looking at our market volumes insight, and I'll also be looking at trucking supply and demand. So when you click on these, you can open them up and it'll give a very good overview of what these indices are. And as you read them, you'll need to learn and learn the abbreviations for the indices that we'll use in our charts. And you'll see those like right here: OTRI, Outbound Tender Rejection Index; ITRI, Inbound Tender Rejection Index. And we have for our lanes, we have van inbound tender rejection index. And then, of course, we have weekly change, bi-weekly change. But these are the indices that you'll use when you're looking up these indexes on our charts. And you'll type in the index VOTRI, and you'll put a period, and then you'll type in the market that you're looking at. And we use airport codes. So Atlanta is ATL, Memphis MEM. Or of course, you can look at the national, which is would be .USA. So VOTRI .USA will show you the national, and of course you can break it down into each market. And you can find this information in our knowledge center. So it's very important. If you have a question, look in the knowledge center, and you're allowed to find your answers there. And of course, going through all these indices and learning is very knowledgeable for you to do. So I'm going to jump back in here to my Sonar. And the first thing I'm going to do is I'm going to go down here. I'm going to create a page for this training session. So I'll go down here to edit pages, and I want to click on edit pages. Right here above it, you'll see add page. I'm going to type in Sonar training map and press enter here. And when it first pulls up, you're going to see that it's a blank page. So we want to go to the blue plus sign here in the top right and click it. And I'm going to scroll down to map. And this brings up, of course, the map of the United States. And you'll see here with the lines drawn, you'll see all 135 markets that are divided out here. And I want to go this little indicator right here. You see it kind of, if you not sure what that is, but that is the truck. That's the cab and the beginning of the box. So I want to click on the truck, and I want to scroll down here. I want to turn our chloropleth settings on. And then down here at the bottom, I want to choose the legend. And right here, I'm going to choose the type of map that we want. So as I open this up, I'm going to look at volumes first. So I'm going to type in volumes, and I want to look at outbound tender volume index. So I'm going to kind of scroll down here, and I see inbound, long haul, mid haul, outbound tender volume index. I want to click that one, and it'll populate. And I'm going to click this little blue arrow to send the information back over. Now, this little map here is going to show me all of our 135 markets and the volumes that are in these markets. If you look at your legend down here, you'll see that 0 to basically 93.26 index points. Those are our smaller volumes that are shaded white. Now, these volumes, they are based on an index. In 2018, March 1st of 2018, we started this new index, and we started the national level, all the markets together at 10,000. And we broke them apart by their market share, what percentage of the 10,000 was in each market. So we started at 10,000 on March 1st, and we used March 1st. It was a good intermediate market. It wasn't spiking in March 1st. It wasn't a very low market in March 1st. It was a good intermediate market. So we used 10,000, and we started at March 1st. And that's a good index to kind of realize when we're looking at our freight volumes. If you're looking on a national level, are they above 10,000? Are they below 10,000? And we want to see that the market volumes keep above 10,000. When they get below 9 or 10,000, they're still, it's an intermediate, low intermediate, but we like to see them above 10,000. So as we broke these out here, I'm going to hover over. This is Ontario. You'll see that it says, first of all, ONT. That's the airport code. So if I wanted to look up this indice, outbound tender volume index is OTVI. If I wanted to look up Ontario on our chart, which we'll look at next, I would type OTVI.ONT. And we show 465 index points for Ontario. Ontario is one of the largest markets, so understand these large markets will be in the 400 range, high 300s into the 400s. And that is part of that 10,000. If we added up each of these markets that are on this map, the white ones and the blue ones, they would all add up to what we had today, which I believe was around like 10,023 or 25. So we follow through. We see a light shade of blue. As these markets get darker and darker with their shades of blue, that means they have higher volumes. So as we look at these markets that are a dark shade of blue, we see Ontario, LAX. We see Dallas here in the middle. That's a lighter shade of blue, but it's still one of the larger markets, 245 index points. We see Atlanta at 381 up here in the top right. That's Harrisburg, PA, 338. Again, Harrisburg is airport code MDT. And then look over here and kind of the top middle, and we have our Chicago market. Those are the real big 6 markets that have a lot of the large railheads, and that's where a lot of the market, the goods will flow in through like the LA ports, and they'll move to Chicago, Dallas, Atlanta, and Harrisburg, and Memphis here. And those are some of the largest markets that we have that are based in the USA. So this tells us basically where the freight is. So when you're looking at your volumes map, it's a high 30,000 foot elevation map that gives you the colors so that you understand this is where the freight is. And if you want to, you can hover over and get a number, but we're looking at first at the colors. So you can hover over Atlanta here, and it'll show you 381 index points, and the airport code for Atlanta is ATL. So this is good information to let you know where the freight is really quick. And if you're booking large carriers, understand that they would really right now, when the markets are kind of down, they want to run their trucks to areas that have larger freight volumes. So this would also identify the Midwest, the areas in the Northeast, and Atlanta in the South, that these are areas that have a lot of outbound volume. So they're going to want to keep their trucks running to these markets because they're going to have an easier time getting these drivers out. This has nothing to do with price, but it lets you know that there's a lot of volume so you can keep your trucks rolling. So next, we're going to look at this, and we're going to bring up a chart. And I'm going to start another page for a chart. I'm going to go down here to Edit Pages. The little blue Add Page clip pops up. I'm going to click on that, and I'm going to put SONAR 201 Charts as my new name, and I'm going to click Add. And when it pulls up again, you're going to see that this area is blank. It's always going to be blank. So we're going to go up here to this blue plus sign, and I'm going to drop down to Charts. And I'm going to click on Chart. And here it brings up, and it's still kind of blank, but we're going to type in this OTVI.USA just to kind of bring up what the National's doing. It was at 10,024. I'm going to click on display here, and I'm going to scroll down, and I'm going to turn it on large fonts so that I can see my numbers and read my map a little bit easier here. And so what we're looking at here on the y-axis on the right-hand side, that is the information of your main index, which for me is outbound tender volume index for the United States. And this will tell you what that number is. So today it's 10,024.41. On the bottom here, this is our dates. So today is the 9th, and our information is about 24 hours old. So here, this information right here, this is the 8th, and of course the 7th. It's picked up between the 7th and the 8th, and then back to 5, 4, 3, and the 1st of October, right around in here. So what I like to use charts for is this really tells us, it shows us the changes and the trends of the markets. And this is really important here. I can compare this information if I wanted to compare the outbound tender volumes of LAX. I can click the compare and hit enter. And here it gives us kind of two flat lines. It's because it's trying to compare an index of 10,000 to an index of 344. So I always like to keep these on a dual axis, which you click on the display button, you scroll down here to dual. And once you change it to dual, it really shows you, it gives us two axes now. It gives us the y-axis on the right, that is our main indice. And the indice that we're comparing to is on the left here. So we see the 344.13 for LAX. So we can really see the ups and downs and how these two markets compare. I can scroll out a little bit, or I can click the 1 month, 3 month, or 6 month buttons down here, and they'll open it up. And you see how the LAX market really resembles the national market. And that's because LAX is such a large market. Um, Here in the last few days, we kind of zoom in here, we see where the LAX market kind of picked up a little bit. And here overall nationwide, the trends in the volumes kind of trended downward. So this is where you can get a lot of good information of what's going on with the volumes. And if you want to, you can look at the volumes for just LAX, type it here in the main indice, and you can compare this to, let's say we want to compare it to Memphis. And we can look at the volumes of Memphis. Again, even though the red line here for Memphis is above LAX, look over here on your left to the y-axis, and Memphis is 169.23 index points. And on the right over here, LAX is 344.13. But you can see how they interact together. And again, here in the last couple of days, you've seen here where LAX and Memphis both kind of picked up between the 7th and the 8th, as a lot of markets in the US kind of actually dropped down. Now we can go over here and click the X button and get rid of Memphis, and you can also compare other indices. OTRI.LAX, these are our outbound tender rejection indexes, which we'll talk about here in just a minute. But I want to show you here, as you type this in and hit enter, you can compare this indice as well to our market volume. This is the percentage of rejection rates, the willingness of carriers to run loads. And you see it's at 2.63%. Again, this chart shows us where it's been trending upward compared to what's been going on with the volumes in LAX. So I love our charts here. Charts is one of the biggest, is what I use the most, because as a broker, I'm really interested in what's going on in the last few days with the markets. Are they trending up? Are they trending down? How's this going to affect my pricing? And of course, here I see where volumes are trending up, and tender rejection rates, which we'll talk about here shortly, they're also trending up. Now, again, in volumes, we have a new indice, OTVI.LAX. That's our every volume of all the trailer types together that are in the LAX market. And so that's your reefer, your dry van, and your flatbeds, and your tankers, all this together in one big indice. And starting this week, we just separated these indices out to where we could also look at, we're going to call it VOTRI.LAX. I'm going to compare it, and that's van outbound tender reject tender. Let me back up here. VOTVI.LAX, and that is van outbound tender volume index. We have broken these volumes down into dry van and reefer, and this is going to give us a better idea when we see markets changing. It could be the flatbed market changing, it could be a tanker market, or it could be the reefer market changing, and it may not have an effect on the dry van. So we want to be able to break these down. This is a great way to do it. I'm going to hit enter here, and you'll see where the dry van market. It's a little bit below the line. The index is 278, and that's because your dry vans represent about 75 to up to 80% of the markets on the most freight that's actually outbound. It's mainly about 75 to 80% dry van. But I can also compare this again to ROTVI.LAX, and this is the total volumes in refrigerated equipment. And you see, of course, it's way down here. It's at 16.63. So if I want to compare this to overall, I've got on the right here, I've got my OTVI, my total volumes. I've got 278 for my dry van and 16.63. But since I have both of these on the same y-axis on the left-hand side, I'm going to X out the volumes for dry van. And then, of course, you'll see where now we're just using one indice. It'll show you the ups and downs of reefer. So we saw dry van picking up here over the last few days. Reefer also increased, but not near as much. So we can conclude that most of the freight volumes that were picking up in the LAX market were dry van. Now, I want to go back to my map here, and I'm going to change my map, and we're going to look at inbound volumes. So when my map comes back up here, I'm going to click right here where it says outbound tender volumes. I'm going to click there. I'm going to scroll down to my chloropleth index, and I'm going to type in volume again. And I'm going to scroll down, and I'm going to look for inbound tender volume index. It was above. Inbound tender volume index right here. And I'm going to click my little arrow to clear that. Click my big arrow up here, and this makes it full screen here. Now, this map looks a little bit different. Now, this is using the same information that we had for our outbound tender volumes, but the outbound tender volumes was based on the shipper. It was showing me what markets it picked up in. Well, this is the same information, but it's based on the consignee. It's telling me where these loads are going. So we see, for instance, over here, Florida's a little bit more blue because there's a lot more volumes that are going into Florida. So before we're looking at outbound and they were white. That's because there's not as much outbound from the Florida market. But now we're looking at Florida and we see a lot more blue in these markets. And that's because there's a lot more inbound into Florida, as well as the Northeast. Look at all these markets going up the Northeastern seaboard, New Jersey, Boston, Rhode Island. All of these are shaded blue, and that's because the Northeast absorbs a lot of freight, and there's a lot less outbound. So we see these turning blue, and it lets us know where the volumes are going and help you understand. You got a lot of loads that are going up into the Pacific Northwest, and you can hover over these markets, and it'll tell you, going in inbound Seattle, 172 index points. So inbound volumes let you know where the freight is going. Outbound tender volumes let you know where the freight is picking up. And of course, we can also go to our charts, and the inbound tender volume index is ITRI.LAX if you want to look at the Los Angeles, and you'll see that, how about ITVI for volumes, LAX. And we see the inbound into Los Angeles is 218.51. So if that's the inbound, what about the outbound as well? And that's how we actually measure our Headhaul Index. So that's what we're going to talk about next is capacity. Our Headhaul Index is haul dot, and then, of course, the market. We could do USA or LAX. So looking at LAX, our Headhaul Index is our outbound tender volumes minus our inbound tender volumes. And that lets us know the flow of trucks. By knowing what's coming into the market, those trucks should be being loaded and going out of the markets. Well, if we bring up the Headhaul Index on our main indice, and then I'm going to compare that to OTVI.LAX. And I want to look at the outbound. Oh, let's type haul in. I didn't compare it. I typed in the main indice. So we'll type haul.LAX in the main indice here, index. We're going to compare this to OTVI.LAX. And that's going to be our red line. And I'm also going to compare it to ITVI.LAX. And what this shows us here, if you look on the left, on the red is outbound. 344 index points is our outbound. and 218.51 is our inbound. The 344 minus the 218 gives us the 125 here that we see on the right. And therefore, we have a head haul index of 125 index points. Now, 0 is balance. And of course, if it's negative, that means there's more inbound trucks than outbound trucks. Basically, 0 to 25, or even negative 10 through up to positive 25, those are balanced markets. Just as much inbound as just as much outbound, so they pretty much cancel each other out. As we get over about 25, we start to get a little bit excited that there's a lot more outbound trucks, and that can start tightening capacity. So when you start getting above 25 or even negative 25, you start getting a lot below negative 25, then you can say there's a lot of excess capacity in the market and you're gaining trucks. So here's a great way to understand what capacity is doing in the markets. But when you look at these, we want to see the trend here, of course. We see it trending upward. And that's good to know that the capacity in the Los Angeles market is tightening. But you also want to look at the Headhaul Index on a map. And the reason why is because we do not measure deadhead, trucks that have deadheaded from a different market into the markets. So here I'm going to bring up my Chloroplast settings, and I'm going to type in head haul, and I see here it pops up real quick here. I click on the head haul index, and I close my little information button there. I'm going to close the other part to make it full screen. And you see a lot of reds and blues and whites. Look at our index, our legend down here at the bottom. You see where it starts at negative 125, goes up to the white markets are basically negative 25 to positive 25. And as it starts getting positive, it starts turning different shades of blue. So the red markets are trucks that have a large excess of trucks in the markets. White markets are neutral. And the blue markets, as they shade darker, have a surplus of trucks in those markets. So we're looking at LAX right down here, which that's San Diego. Let's get it up here a little bit higher to LAX, and you see the 125. When you look at this on a map, you want to look at the surrounding markets. So here we see Northern California. So you got some white markets and some red markets. Down here beneath it, we have, or to the east of LAX, we see the Ontario market, which is 76. We have Ontario and LAX separated. Ontario represents the ports that are coming in, and Ontario has a lot of the warehousing. So we separate those so that we want to be able to see what is coming in the ports and what's staying in the warehouses and how that freight flows. So down here to the southeast of it, we see the Phoenix market, bright red, negative 98. So the Ontario market and the Los Angeles market are surrounded by markets that are either neutral or are red, which means they have a lot of excess capacity. And what this is going to do, since they have a lot of volumes going out of these markets, understand when you see a market that's in blue surrounded by weaker markets, it's going to attract trucks to deadhead to that market. If the LAX market was surrounded all the way by a bunch of blue markets, meaning they all had were tight on capacity, then they probably would not be moving their trucks because they didn't need to move their trucks. There's plenty of freight in that market and plenty of options for them to get a good rate out of to not have to deadhead to a different market and spend that money. So if you see it weak here, if we look at Memphis over here, it's surrounded by a lot of neutral markets that are white. You'll have trucks that deadhead into Memphis right now. Of course, Atlanta has plenty of trucks right now. It shows a head haul index of negative 27. So knowing that it's negative 27, that's probably going to hurt your rates. And it's going to push your prices down. The blue markets will bring the price up because they're tight on capacity unless you're having trucks deadhead into those markets. Looking at the overall U.S. map, it looks pretty grim out there. There's not a lot of markets that are tight on capacity. The ones that do have a lot more inbound than or outbound than inbound are surrounded by a lot of markets that show either neutral or red for excess capacity. So they'll get trucks moving into those markets to balance out the capacity. So no huge capacity demands in the U.S. right now. I'm going to also bring up a tree map. So I'm going to add a page again by clicking on Edit Pages. I'm going to add a page, and I'm going to put SONAR 201 tree map and click the add button. Again, it's going to pop up. It's going to be a blank screen. And I'm going to click my blue plus sign and come down here and select tree map. I have to name it again. SONAR tree map. And I'm going to click manage symbols. Now, a tree map shows all of our markets, and it's not on a US map. It's basically in one big square. And I'm going to first bring up our volumes, and then we'll look at volumes are going to be under market volumes. I'm going to scroll down. And they threw me a curve on this one. They normally under market volumes, but we started this new indice here at the top 5 most popular trucking indices. That's where you're going to find your market volumes and your outbound tenure rejection index rates if you want to do a tree map. I want to click X for the X markets. That's all 135 markets. I'll scroll down and hit select these items and then done. I'm going to scroll down here and click save. Now this is going to populate our tree map. A tree map is great information. Again, it lists out all the 135 markets, and here in the top left is our largest markets, and it works its way down and to the right. In the bottom right hand corner are our smallest markets. Now we're looking at volumes right now, so if you're curious what the top 5 markets are in volumes in the US, they're listed right here: Ontario, California; Atlanta, Georgia; Los Angeles; Elizabeth, New Jersey; and Harrisburg, PA, here in the bottom left-hand corner, just a little bit bigger than Joliet. But here are your big markets that you can see. Now, when we look at this little box right here, you'll see Ontario, California, and then you'll see 0.7%. This number on the percentage is the increase or decrease since the last time that we measured this index. We measure market volumes every day. So since the 6th or the 7th to the 8th, this market has increased 0.7%. And the number down here below it, 465.60, this is the actual number of the volume index. So Ontario, California, as we saw before, has 465 index points. That's its measurement for volumes. And I should say, you can scroll down, you see as the boxes get smaller, that means the markets get smaller. If the boxes are shaded in a green, that means they've had an increase. This kind of bluish purplish color here means they stayed pretty well close to zero. So if they had a small increase or a small decrease, they'll stay this little grayish blue color right here. And of course, the markets in red, these markets have declined since we last measured it in the 24-hour period. So Salt Lake City, negative 2.8% decline, and the outbound tenure volumes is 130.09 index points in the Salt Lake City market. Now we can X out of this map and build a second one, and tree map. SONAR Headhaul Index. I'm going to manage symbols here. I am going to scroll down to truckload volumes. Supply and demand. Here are volume insights. And Headhaul has been probably moved up to our top 5. Here it is in our top 5. I'm going to click the X markets. I'm going to scroll down and select them, and you'll see them populate over here to the right, and done. And then I'm going to click save. Now, the Headhaul Index is very interesting when you bring it up on a tree map, because you can have positive and negative markets right here in the middle, this very distinct line. This is 0. And to the left of this are positive numbers, which means there's more outbound than inbound. And to the right of this are negative numbers. which means there's more inbound than outbound. Of course, as you get a higher negative number, the boxes get larger. And as you get a higher positive number, the boxes get larger. So, Headhaul Index, Los Angeles, 125 index points. That's our largest head haul index for each market. And it has increased 5.3% since the day before. You can again see the ones that are in green have a positive increase, and the ones in red have had a decrease. The market with that you would say has the loosest or the most excess capacity would be Phoenix, Arizona, down here in the bottom right-hand corner at negative 98.37. So again, we've given you just a lot of information that you can pull up in different ways. And a tree map is one that's really good to use. Again, I like looking at the volumes and tender rejection rates in our tree maps as well to help understand what's going on in the markets besides just on the US map, because these tell you the largest ones in one group on one side, and of course your smallest ones as you move across to the right. So head haul measures capacity, and our outbound volume OTVI measures our volumes for each market. We've got a new index that we've created here, and I want to go to our knowledge center here again right quick and click on it. I've already opened it up when I first started, and it's called Tender Rejection Index. If you read any one of these, this is the main index that you need to read out of all the indexes that we have. Please open it up. Please scroll down and read what's it about, what does it tell me, who's interested, and all the different breakdowns that we have for the tender rejection indexes. We have reefer, dry van, flatbed. We have weekly change, bi-weekly change, monthly change, annual change. And it tells you a lot of information of what you could do. And what's really important about tender rejection rates is they correlate with spot market rates. And how they do that, let's kind of take a look and see how we can look at that. I'm going to bring up OTRI.USA, and this is the outbound tender rejection rates for the United States as an average over, right now it's just over a month, but I'm going to compare that to DATVF.VNU, and this is the average long haul rate that DAT posts that they've measured for the United States. So if we go back and we click on 1 year, we're looking at the tender rejection index that we've created, and we're comparing it to what DAT shows as an average rate that they've posted for each day. And as you can look, you see where these peaks and valleys here back in, let's scroll back a little bit further. If we look at April, and this is the peak here, April, May, and June, this is produce season for 2018. You see where in the blue line, our tender rejection rates are going up, and you see on the purple line where DAT is showing your spot market rates increasing. And as our blue line goes down, you'll see the purple line follows it. They work very, very well together. They correlate very well together. Now, there's some spaces in here, but that's because we are comparing a rate per mile, dollar amount, $1.41 to a percentage, which is 5.14%. So it's important to see the correlation of the ups and downs to realize that when tender rejection rates are increasing, spot market rates are increasing. When tender rejection rates are declining, spot market rates are declining. One more that's really important about our tender rejection rates. If you look here, the purple line being the average rate for DAT, it ends here on October 2nd. It has stopped. And you see our data has continued on. And that's because when you're using a rating tool, not just that, but any rating tool, the information can be 7 to 10 days behind. So today is October 9th. This one is 7 days old on October 7th. And that's because it takes a little bit of time. These loads have to pick up, that the driver has to send the paperwork in. Then the data is entered into the system and it's collected. And then you have to wait, a few more days to get a large enough sample size to give an accurate rate that DAT provides. So that takes a little bit of time, and they are 7 to 10 days behind. What's good about tender rejection rates is we only measure the loads that are accepted and rejected in a system and not even looking at the rate. And we can see if spot markets are climbing in the market or declining in the market in the last 7 days. So using this tool where you can get a lot of value is you can tell by our tender rejection rates what has happened in the last 7 days. Have you seen it increase? Have you seen it decrease? And this can really help um, people keep from overbidding loads or underbidding loads. If you've had a market that's picked up 2 or 3% on tender rejection rates, and you're looking at your rating tool, there's a high probability that the market rates have picked up. And if you go by your rating tool, you'll actually be underbidding that freight. And of course, you'll win it, but not at maximum revenue. Let's say around the first of the year, we all know around the first of the year that the freight rates drop in January, in early January. Well, if you're looking at the 2nd of January and your information is 7 days old, you're looking at a rating tool that's going to be showing you rates between Christmas and New Year's, which could be pretty well elevated. In that case, tender rejection rates have dropped. And as you put your bids out there, you're not going to be winning any freight because you're overbidding your freight. And obviously, we have to win freight in this market to be able to make money. So if you're overbidding freight and not securing any freight, you're not making any money. So that's how outbound tender rejection rates correlate with our spot market rates. And of course, it's all relative to the contracted rates that are in these markets. So let's kind of start out here. I'm going to pull up the same map that we had here before. Click on our Sonar training map that I created as we started. And I'm going to click on the truck again, go down to our Chloropleth index, and I'm going to type in, let's see here. I'm going to type in reject, and there's inbound tender rejection index. I'm looking for the outbound tender rejection rate. Outbound tender rejection index. Click my little blue arrow here to close it. Click the big arrow up here to make it kind of full screen here. And here we're looking at the US map of tender rejection rates. So out of 100 loads in a market, if you had 97 that were accepted and 3 loads that were rejected, we would say that has a 3% tender rejection rate. And that's pretty much a 97% acceptance rate. And what we're doing is we are measuring the willingness of drivers to run loads out of a market at a contracted rate. And that's a very key element right there, at the contracted rate. Why would you decline contracted rates out of a market? And the number one reason is if you have better options that pay a lot better freight rates, you're going to decline your contracted rates and pick up loads that pay better. So therefore, that will count as a tender rejection. And as we see tender rejection, as we see spot rates pick up, carriers are more willing to decline their contracted freight and go out and pick up other loads in the market that pay better. So you'll start seeing tender rejection rates start to increase. Right now, I use a scale about 0 to 3%. That would a 0 to 3% tender rejection rate. That would kind of tell me that spot market rates are below contracted rates, and that since they're so low, that everybody's accepting their contracted rates. About 3% up to about 7%. That kind of lets us know that contracted or spot market rates are kind of right below, right at, or maybe just above contracted rates. And that really depends on how you turned in your rates for contracts. Were your rates a little bit elevated? Were they really, really low? And so everybody's going to be a little bit different. So right between the 3 to 7%, you can be just below, right at, or just above. And that lets you know, the contracted rates are pretty well even. When we start breaking the 7% mark, we kind of start explaining that is where spot market rates are climbing above contracted rates. So therefore, that allows carriers to go, or brokers to go out and book loads off the spot market or accept their contracted rates and go out to the spot market and get capacity. And in that case, if the spot market rates have climbed above the contracted rates, they're liable to lose money on those loads. If they're between 0 and 3%, they can accept their contracted rates, go out to the spot market, find capacity, and their spot market rates are going to be below. So that actually increase their margins as the percentages are lower. So that's really important to understand, especially bidding freight. If you see it start getting above 10%, that means the spot market rates are really climbing up. above contracted rates. So in that case, if I'm a broker, I may not accept my contracted freight if I have that option. And I might go out to the spot market and start bidding on spot loads that are out there from the shippers, because they're going to be having some trouble covering their freight as well. And in that case, I'm going to start upping my bids. There's market volatility, spot market rates are climbing. I'm going to start increasing my bids because I can see that tender rejection rates are above, 9-10%. So this is where we see it on a map. You can see buyer index down here, 1 to 8.25% are in white. So these are a lot of the markets that are right at or below your contracted rates are in white here. And as the market starts shading blue, you see in our legend 8.25 to 15.41 or a light shade of blue, and they start climbing up with darker shades of blue. Of course, we see some of these darker shades of blue in markets like North Dakota, and that's because their volumes are so small in Bismarck, North Dakota. So one or two tender loads that are rejected can actually really push the tender rejection rate up. But these are in volumes that are markets that have very low volumes. So this is where where it's hot and where it's not. Now this can be broken down into dry van and reefer. So if we click here on our map, and I can type in van, and I see van outbound tender rejection index. So this measures the willingness of a dry van carrier to run loads out of a particular market. And again, we see markets like Los Angeles down there, which I explained a lot of people were deadheading to that market because of the volumes. Their tender rejection rates are very low because they have a lot of capacity, 2.51%. And that would kind of tell me that right now the spot market is probably lower than contracted rates in the Ontario market. So rates are very, very cheap. We see up here in the Midwest, we see markets such as here in the Bread Belt, Cedar Rapids, 17.54%. That means a lot of the contracted loads in Cedar Rapids are being declined, and they're probably choosing loads that pay a little bit better rate because maybe capacity is tighter in that market, but the spot market rates have pushed up well above your contracted rates. So we can look at this in dry van, and we can also type in reefer and look at it in reefer. But for the reefer, I'm actually going to bring in the inbound tender volume index just to explain this a little bit. By looking at inbound tender rejection rates, this explains the willingness of drivers to deliver into a market. So if you see some markets that are actually weak that maybe drivers don't want to go to, they're actually going to reject these loads that are inbound to, let's say, Atlanta's kind of a darker blue over here. They don't want to go to Atlanta because they think the Southeast is really weak right now. So they're going to reject their contracted rates and increase their rates. So therefore, it's showing us that when you have a higher inbound tender rejection rates, drivers are not quite as willing to go to that market, and they want a higher rate. So you can kind of check these out, and this will explain where the markets that rates are increased for inbound freight. Good little key indicator right there. All right, now let's get to some charts looking at tender rejection rates on a chart. We'll pull up otri.mem for Memphis. And we see here over the past few days, October 2nd, which is right about here, was where our rating tool is at. And you've seen it's gone from here about let's click my little thing and let's see where it's at. It's gone from 5.34% up to 6.16%. Now, this is our outbound tender rejection index. This is dry van reefer, all of it. So we see an increase in this market. So there's a possibility right now that using our rating tool, that the rates in this market have climbed up higher, and our spot market rates are climbing up to maybe just above contracted rates. Now, I can break this down. Turn my little blue box here off. I can break this down to VOTRI.MEM. I misspelled that, VOTRI.MEM. And over here on my left axis, you can see it's at 5.68%. I can type in ROTRI.MEM, and these are the reefer tender rejection rates. And they're quite different here. Reefer tender rejection rates are at 35%. So whenever I'm looking at outbound tender rejection index and saw it at 6.16, I always want to break this down to the type of trailer that I'm using. So at 35% for reefer, that explains that um, spot market rates are well over contracted rates in the Memphis market. 35% of the contracted loads in the Memphis market for reefer are being rejected. And for dry van, only 5.68% of loads are being rejected. So the rates are a lot lower. You see here where the dry vans are trending up a little bit, and the reefer tender rejection rates are actually trending down. But even though they are trending downward, the actual spot market rate is still fairly elevated in the Memphis market. So if I was bidding freight, I would still keep my rates elevated in the reefer market. And looking back here at our for reefer, right here around October 2nd, our rating tool would be here, and the tender rejection rates have actually gone down a little bit. So I might adjust my rate downward just a little bit from what my rating tool will be telling me to price a load out of Memphis. All right, so we can compare. We got reefer tender rejection rates. We got dry van tender rejection rates. We also have tender rejection rates for lanes. So I'm going to actually X out my reefer here and my dry van, and I'm going to keep my outbound tender rejection rate as the main indice. And we have lanes that are broke out, and COTRI, which is city outbound tender rejection index, Memphis. These are all trailer types again, and these are loads that deliver between 0 and 100 miles from Memphis. So what's the rejection rate percentage of loads that are being delivered between 0 and 100 miles from Memphis? And for this indice, it's 0.56%. I have SOTRI.MEM, and these are loads that are 101 miles to 250 miles from Memphis. And you can see they're starting to pick up some, 8.56%. I have MOTRI.MEM. These are mid-haul. These are 251 miles to 450 miles from Memphis. And here they're at 4.91%. I have TOTRI.MEM. We call this the tweener haul. This is 451 miles to 800 miles, and it's 8.31%. And then, of course, finally, LOTRI.MEM. These are long haul loads. So looking at this right now, the short haul and the tweener haul loads are the highest rejected loads from the Memphis market at a little bit around 8.5% on each of them. And that kind of lets us know that for those lane types for 100, 250 miles or 450 to 800 miles, those lane types will take an elevated rate to pick up those loads because currently carriers are rejecting contracted rates for those lanes and going and picking up loads that pay better rates. Of course, long haul is 4.88%, right around contracted rate. Mid haul is 4.91%. And of course, a lot of your city loads are pretty well contracted out or an average rate. So there's very little rejection rates on the little short haul load between 0 and 100 miles. Now, what's important to look at are all these trends. You see where short haul is at 8.56%, but it's trending downward. While tweener haul loads in the yellow here, these are trending up to 8.31%. So you want to look at the trends. Here, long hauls are trending up, meaning that rates are increasing, or rates are decreasing of trending down. Now, I'm going to kill a lot of these and look at just the tweener haul load because that's a very important lane to me. The reason I like to look at the tweener haul load is because it's a key indicator of what is going on in the market, in the Memphis market. I see it trending upwards. Tweener haul being 450 to 800 miles, that's one of those lanes that's very it underutilizes trucks. You might drive a day and a half and it may take you 2 days to deliver. So those lanes will actually be turned down if other lanes are available. So we call that optionality. So if there's other options in the market, they will turn down the tweener haul loads and they'll try to get the mid haul load. They'll try to get the long haul load, or they may take a short haul load. But when markets get tight and rates start dropping and there's not quite as many options, they'll start accepting these tweener haul loads. So when you start seeing the tweener haul loads at a low rate, and 8.31 is not a very strong tender rejection rate. but it is higher than what I've seen in some of the other markets. So by looking at these, you can kind of tell what's going on in the market. We see here for Memphis, we see the tweener haul tender rejection rate increasing. That tells me that their optionalities in the Memphis market, they're starting to open up and rates are starting to pick up. So a good key indicator by looking at this this indice of what is going on in the market. So outbound tender rejection rates, the willingness of a carrier to pick up a load in a market. When tender rejection rates start to increase, it's probably means your spot market rates are also increasing. Inbound tender rejection rates, the willingness of a carrier to deliver into a market. If you see tender rejection rates increasing the inbound tender rejection rate increasing in a market, that means that the rate for a carrier to deliver into that market might be picking up. So you need to keep those in mind when pricing. As you see those inbound tender rejection rates picking up, increase your bids. If you see them going down, of course, you can lower your bids. Now, another way to look at all of this, of course, I always start out with my maps and I pull up each market and I break them down. I always look at volumes. I always look at tender rejection rates and break it down by dry van and break it down by reefer, and maybe look at which kind of lanes are in each of the markets to see what's going on and get a full understanding of what is going on in each market. I'm going to create another new page and show us a new little tool. A volatile market map is what I'm going to name it here. I'm going to add that. I'm going to go over here to the top right, blue plus, and down here at the very bottom, you'll see most volatile markets. These are all already have X's in it. It's already got it built for you here. You can choose, hit the X here at all and clear them all out and just choose a couple of markets. Or I'm going to keep all the markets. I'm going to scroll down and I'm going to hit the save button here. This brings up all the 135 markets, their airport code, the market share percentage, and it brings up their outbound tender volumes, the outbound tender rejection rates. Now, this is all trailers combined. It brings up the Headhaul Index, and it brings up the tender lead times. Now, tender lead times are a good way to also measure what's going on. You can bring those up on a chart as well. It's TLT dot and your airport code. So TLT.ATL. When shippers see rates increasing, they normally start extending or raising the tender lead times. When shippers see carrier rates declining, they'll bring those tender lead times in. Imagine when spot market rates are well below contracted rates, shippers are booking their loads same day on the spot market to save money. You'll see very short tender lead times. Ontario, California, 1.78 days. That's a very short tender lead time. That would tell me that probably a lot of these shippers are moving their freight over the spot market. Now, you can compare these, but as we scroll down through, you'll see some green boxes and some red boxes. What we're trying to do is measure a change in these markets where you can quickly identify these. And we do that by taking the average. So here's my Headhaul Index. It's got green right here for moderate increase. We take the average head haul indice for the Dallas market over the entire year. And then if it's within a 7-day period, the last 7 days, if it moves up or down, one standard deviation will start shading the box either a green or a red, whether it's increasing or decreasing. And that lets us know that there is some, not just movement, because we don't put any type of movement shaded. That would make it where it's useless. But we make it one standard deviation to let us know that the market is moving up or down within the past 7 days. And you can scroll through here and find what markets are really picking up or really declining real fast, so you can understand if you need to adjust your rates. And this is over a 7-day period. So definitely bring this up and play around with your volatile markets map, and you can see what's going on here. Louisville, Kentucky, their tender lead times have picked up to 2.59 days. And you can look at that on a chart as well. You can click on it and it'll bring up a chart so that you can look here in the past few days. It's gone from 1.9 days near the 1st of October up to 2.59 days, letting us know that tender rejection, that our shippers are probably seeing rates increasing. But here it also brings up OTRI, where we see tender rejection rates that are falling, and that could be because it's the Louisville, Kentucky market. But a lot of good indices to bring up and compare, and these will help you out. Definitely look at volumes. Definitely look at your capacity controls, most of what happens with your rates, and then go into your tender rejection index. And that really correlates with what's going on in the spot markets so that you can understand which direction the spot markets are going to adjust your rate from using your rating tool. And look at all these indices. Never judge a market by just one indice. So bring them all up on charts so you can tell which direction or changes are happening in each market. We're running out of time here, so that's actually going to conclude our training for today. If you do have any questions, please email us and we can get back with you. Or if you need additional training, we're also offering SONAR 301 on Thursdays at 11 a.m. And we go over different indices such as the maritime indices, the rail indices. I believe tomorrow we're going to be going over some of the indices that we're measuring for biodiesel and the changes that are happening in that area. And but click in, send us information, and sign up for 301 classes. Thank you.